It's post-Sandy, post-election, and we're all waiting for Vince Lanci's point of view. He's back and he's up next. We've gone too long without you, Vince. Glad to have you back.
We're happy to be alive after Sandy, but yes, thank you.
So Vince, it's post-election, Obama's in power. Has everything gone according to plan, at least on the market fronts for you?
Election-wise, I had an opinion, but I didn't think it would matter to the markets who got elected. I don't really think the markets are too concerned with who is in charge, so long as Bernanke or a successor of his is in charge of the monetary policy. And things are going to be the way they've been for the last 4 years.
So Vince, today I thought it would be fun to start by looking at how the S&P has performed versus gold these past 4 years while Obama has in power. If we pull that chart up now, we'll see that gold has outperformed the S&P. So do you think we'll have 4 years more of this?
Yes, I can. In fact, post his election, the market was strong, and market by market, I mean stock market. And then it's just gotten weaker since then. Looks to me like gold doesn't have to go up to outperform the S&P moving forward. I think we've got some bad times ahead for stocks.
So Vince, do you think the markets are still focusing on the results of the election, or is everyone over it?
Yeah, I think over it's the right word. The markets, if they were focusing on the election, stocks would be doing better because Obama is a continuation of the same policies. Stocks are doing poorly, gold's doing even better on a relative value basis. So that would force me to believe that the markets are focusing on the so-called fiscal cliff that's approaching.
So Vince, you do think the markets are reacting to the looming and upcoming fiscal cliff?
Yeah, the markets are reacting to uncertainty. So they abhor uncertainty and they do not believe that the problem will be solved. My own personal feeling is what we believe here is that at best you'll get a stopgap, which is a fancy way of saying kick their can down the road. And I'm not really sure how the market's going to react to that. It could be a bloodbath if the stopgap measure isn't, satisfactory to the market forces.
Sorry, Vince, a bloodbath for which sector?
For stocks. The stopgap measure, would be related to do we repeal? Do we let taxes increase? Do we keep them low? And it's just lose-lose right now in that situation. And it's the mix of the stopgap measure, I think, that's going to determine the direction of the market. And that's I have a bad feeling. Vince,
I don't like when you have bad feelings, but let's look outside the U.S. now. Let's look to Germany, where we're seeing a slowdown there.
Yeah, to start with the periphery, Spain is both broke and safe. I don't know how Germany and all these other members of the Troika say it, but it's just nonsense. By and large, nothing has changed in Europe, with one exception, and that is, as you were alluding to, Germany itself. Germany is one of the three economic engines that can bail out Europe's periphery. The other two being China, that's not happening, and the US, that's not happening. Well, Germany is showing weakness signs now.
So if Germany's in trouble?
Germany's in trouble, then nobody's buying BMWs. And
so it's interesting, Vince, because it's really the complete opposite of what we saw in 1920s Germany when they were printing and betting on the fact that the US and the UK would be buying their goods, and we all know that didn't happen.
Yeah, it actually is. They say that generals fight the last war. In the 1920s, Germany, post-World War I, just monetarily speaking, printed as much as they could with the hopes that the UK and the US would bail them out by buying their stuff. And that didn't happen because the US and the UK just didn't recover fast enough, and then you had the full-blown hyperinflation in Germany. This time, Germany's deathly afraid of that for obvious reasons, and they don't want to print. They're betting on themselves to bail out their own periphery, and that's not happening. So they're fighting the last war, and this time they're going to have to print. They have to admit it to themselves.
Vince, before I get to my next topic, which will be Basel III, I just want to get your sentiment on gold right now, this week. Let's pull up a chart if we have to. What are your thoughts?
pretty aggressively bullish right now, with specific numbers as a trade, always as an investment in this economic environment. But as a trade right now, we're long, and we have levels to get longer above, and we're very bullish right now.
Vince, a few months ago, you were calling for 1,900 gold before year end. We're running out of time. Are you sticking to that number?
Yeah, I'm gonna stick to that, and if I wore a hat, I would eat it if I'm wrong. But the timing, my timing is questionable. But I think I'm on the right path. Maybe I'm going to be off by a day or two. But we're pretty confident gold's going higher.
So Vince, you're talking about $150, $200 jump in gold by year end.
Yeah. If you we talked about, it might be helpful to talk about this in technical terms. We talked about last week or 2 weeks ago, before the multiple crises hit, that there was a cup and handle formation possibly forming, and I ignored it for the moment. But what happened is, in that chart, the handle, which was basically a down channel, was broken solidly last week, and we're long above 1721. We got long at 1721, and with a 1699 stop, that puts it back in the channel. If you have the chart up, we like the market here, and if it gets to the double top on that chart in the 1785 area and goes above that, there's nothing in the way of stopping the market from going to 1900, we think.
And from what I understand from other technical analysts, Vince, the cup and handle formation is not something that happens often.
No, it isn't something that happens often. You can break it down and look at a cup and handle, and really what it is, it's a double top, right? You've got a top on the left and a top on the right, and that's your cup. And the channel going down, they call that the handle. That's really just a potential bull flag, and it's not a bull flag until you break above the double top. But it certainly isn't bearish now that we've broken out of the channel. So it's a basic formation, and it's usually a very good long-term indicator of the market. So we're happy with it. Okay,
Vince, let's talk about Basel III kicking in January and how it may place gold as a tier 1 capital for bank balance sheets.
Yeah, I think a lot of people have missed the boat on this, and maybe they're just starting to catch up. But the bottom line is Basel III may instate, I don't know if it's reinstate, but may give gold a status as a tier 1 asset. And right now it's a tier 2 asset. And those words mean a world of difference between buying and selling. If you're a bank and you have gold on your balance sheet, or you have gold as an asset, and you need to borrow money from the central bank, well, a tier 2 asset only gets 50 cents on a dollar. So you're a bank, a European bank, and you go to the central bank and you say, here's $1 million in gold. What can I get for it? And they say, well, we'll give you $500,000, or the euro equivalent. Tier 1, on the other hand, you get dollar for dollar in collateral. So you have a Greek bond that's worth nothing, but the ECB says they're going to guarantee it at face value. You can get dollar for dollar for that. So what do you do as a bank, or even as a person? It forces you to hold on to assets that are going down in price and sell assets that are going up in price. I need $1 million. My bank will only give me $500,000 for this gold. Well, I'm just going to have to sell my gold then. However, if you make gold a tier 1 asset, then there's no more need to liquidate to raise cash. I'm getting a cash loan at face value.
So Vince, are you saying in situations like this, countries such as Italy wouldn't necessarily have a need to sell their gold?
Right. If you can get dollar for dollar for your gold, then there's no need to sell it. The whole point is you need to unlock the true value of the asset. And as gold becomes more and more a substitute for money, again, as it was years ago, you're seeing people hold on to it because they don't need to sell it to raise cash. So a country like Italy, which has a large percentage of its FX reserves in gold, this helps them greatly, and it hurts countries with very little gold.
Vince, would you be surprised if you saw some central banks buying again, such as China?
Yeah, China needs to buy gold, and it's almost like a strategic economic war issue for them. If and it's not going to happen. But if the Western world were to go gold standard tomorrow, they're not. But if they were to go gold standard tomorrow, it would destroy China, because China, as a percentage of its FX reserves, has approximately 2% in gold, and they wouldn't be able to compete economically because they don't have enough gold. To make it a little bit more practical, a little more feasible, if the IMF were to create an SDR, depository receipt for international trade, and they decided to change the mix from dollars and euros to dollars and euros and some commodities and some gold, well, right away, gold's worth more. Right away, you need gold on your balance sheet. You need to actually buy gold. Not only are you stopping selling gold, you're buying gold so you can trade with foreign partners. So it becomes like a reserve currency like the dollar.
Good thoughts, Vince. The way you make it seem is that there's a perfect storm brewing for gold.
Yes, and that's always scary. So let me give you the negative side of the trade aspect. So we're long in this area. We're looking at 1785 area to be where the double top is. We're not necessarily saying you should buy it above 1785, but we are saying if you're already long, you might want to see how it acts at 1785 before getting longer. We wouldn't get longer until it made a solid break above that. Between here and 1785, we just think the market will move higher in an orderly fashion. We're just, as long as it's above 1700, we're bullish. If it gets above 1785, we're super bullish.
Thanks so much, Vince. We'll see you again next week.
Thank you. Nice to see you again.
And thanks for watching this edition of Reset. We'll have a new one for you next week. In the meantime, you can email me any comments or questions at newsfeedback@kitco.com, or better yet, tweet me at Daniela Cambone. Thanks for watching.